Janet Engels is a 31-year veteran of the securities industry. She became director of RBC Wealth Management's Portfolio Advisory Group for U.S. equities in 2002. Janet is currently co-chair of the Global Portfolio Advisory Committee at RBC. In addition, she is a member of the firm's directors group as well as its investment strategy committee for global investment management. Janet is a member of the Financial Women's Association of New York and has appeared on Fox Business Channel. She's a frequent speaker at client seminars throughout the country. And on your table, I have some highlights of some of her presentation today and the presentation that she gave to our clients last evening. If you'd like the full presentation, you can see me and we can get a copy of that to you. Janet has been the recipient of RBC Wealth Management's third Weiser Diversity Award in recognition of being an individual who exhibits the company's commitment to diversity. Janet was honored for her commitment to events and speaking engagements in support of and education of women and increasing awareness about persons with disabilities. Janet received a BS in Business Administration from Bucknell University. Please join me in welcoming Janet Engels back to South Central Pennsylvania.
Well, good afternoon. It certainly is a privilege to be here, and thank you so much for the opportunity. I wanted this afternoon to share our perspective on two items. What's going on in the economy, not just in the United States, but perhaps around the world, and also put some perspective on what is happening in the financial markets. We can focus that on the United States. I think it's only fair to give you our conclusions up front, and then we can fill in with some details as it goes along. As I have the opportunity to speak with groups around the country, the feedback I receive is no one really feels very good about the U.S. economy. That feels fairly universal to me across the United States. So my first conclusion is, I believe that the U.S. economy is actually doing better than most expect and are feeling today, and that we believe that we can see over 3% growth, a bit of an acceleration from 2013 levels in the U.S., and we'll try to put that in some perspective. The second conclusion is, after what has been, or what was, a remarkable year in 2013 for the equity markets in the U.S., up over 30%, we also believe that 2014 can be a positive year for the markets. It's going to unfold quite differently than 2013, and perhaps it will not be as robust as 2013, but we think it will be a positive year for the markets, and I'll put that in perspective. So we'll call it around the world in just a couple of minutes. Let me put some first perspective on the U.S. and then talk about some of the other global economies and maybe put in perspective the situation in the Ukraine and Russia and the impact that that might have on the U.S. as well as the global economies. So the first point, 3% growth in the U.S. 3% growth in the U.S. we believe is possible for 2014. We grew at roughly 1.6% in 2013. This will be soon the 6th year of the economic expansion in the U.S., and it has felt very little like any other expansion that we've had in U.S. history. Sloppy, sluggish, anemic, uneven, all of the above, but the most important takeaway for people, it is not a recession. A recession feels much worse than what we've had today. In terms of the opportunity for 3% growth, in our opinion, it's this notion of healing that is taking place beneath the surface of the U.S. economy that is often difficult to see, sometimes from the numbers, sometimes from our daily experience. So what are those healing things going beneath the surface? Well, I'll still agree that we are very challenged from an employment perspective in the U.S. Many different measures of employment, including 3.5 million job openings, including the fact that most surveys of small businesses today are saying that their propensity to hire and actually increase wages and their confidence overall is improving. I will call that some healing. And on the employment side, when I look at a measure of voluntary job departures, you leave from one place to go to another place, usually for the same, if not better opportunity or income All of those numbers seem to be on the rise. Those are encouraging. It's not the end game for employment, but those are encouraging statistics overall. Deleveraging has been huge. We had very high levels of personal debt on balance sheets. They have come down quite dramatically. And net worth, think of the value of your home, the value of one's investment account has increased and is now over 20% higher than the peak of net worth in 2007, before the great downturn and the financial crisis in the US. Look across the United States in terms of some of the developments that are taking place. We believe that there are 3 issues of transformation taking place in the US economy today. One is housing. Now it's already started, and housing will be kind of sloppy, certainly in 2014, not as robust as it was in 2012 or 2013, but it continues to improve overall. That's the first seed of transformation. The second seed of transformation that we're seeing every day is what is happening within energy in the US. So if you want to think and feel good about something in the US, it's not just the shale oil, it's not just the shale natural gas, but it's the oil, which will allow the United States to be energy less dependent than it has ever been in its history. And the net effect of that is not only energy less dependence, perhaps geopolitical less dependence in terms of oil from the Middle East, but it is also creating incredible high-paying jobs within the United States. The third transformation that is taking place is really the beginning of a manufacturing renaissance in the US. I've had the opportunity to talk to a number of people about this. It really has started with these very attractive prices in natural gas, but it is also the encouragement of sourcing things back in the United States. We are the largest manufacturer in the world in the United States. Some can't find that hard to believe. Over 18% of all manufactured goods in the world today come out of the United States. That is larger than China today. And now as we look at wage pressures in China moving up, as we look at quality control issues, the cost of shipping, the cost of friendly or unfriendly governments around the world, the desire to bring more back to the United States in terms of sourcing manufactured goods has increased, and we've seen those numbers rise dramatically. Those are just a couple of examples. Confidence overall in a consumer-driven economy, and that's what we are in the US today, 70% consumption-driven. Confidence is key, and while we're not feeling great about the US economy necessarily, it's not a recession, and we are seeing these confidence indicators rise on a regular basis. So, our opinion, there is some healing taking place beneath the surface of the US economy. The private sector in the US is doing better than the public sector, growing at over 5% today, and we believe an acceleration based on some transformational issues will be unfolding in the second half of this year in the US. Let me quickly look around the world. We are the largest economy. We matter most, and we matter most to just about everyone in this room. What about Europe and China? Europe is out of recession. This is a positive development for Europe, but they continue to be constrained by many very significant headwinds. Headwinds include, there is no growth in Europe today, and there are very, very high levels of unemployment. Can they get through all of that? It's a matter of time. It will take them quite a bit of time. The more important factor, in our opinion, for Europe is their banking system today. So think back, in the United States, we had all these stress tests. All of our financial institutions went under significant tests to make sure that they would be able to withstand another financial crisis should it erupt on our shores. And they are doing the same. It's called an asset quality review in Europe. Banking is more important in Europe than it is in the United States. And the bottom line from an economic perspective, it is nearly impossible to drive growth in an economy if you don't have a normal operating environment for your banking system. That is the situation that exists in Europe today. Their banking system, they're still sitting on their hands, still many issues, and with this asset quality review exam ahead of them, very challenging to see any change in behavior or any change in lending on the part of the European financial institutions in 2014. That doesn't mean the end of the world, it doesn't mean a recession, but it certainly doesn't necessarily contribute to global growth. And then lastly, China. China had some numbers out this morning for those of you who follow the markets and all the numbers. Of course, there's always slicing and dicing of all the numbers. Let me put in perspective our view on China. One of the most important economies because they are the second largest economy. One of the most important economies because the expression now is so goes China, so goes all of the developing economies of the world. Because intra-developing economy trade has increased year after year. China is the dominant player within all of those developing economies. They are in the process of slowing for a number of different reasons. As their economy slows its growth rate, that is having an impact on those economies that grow at a much more rapid pace than the United States and the rest of the developed world. They have challenges in China, that is for sure. They have the third largest credit bubble in history, the largest investment bubble in history. And when we look at real estate values in China today, and we compare them to some of the real estate bubbles that existed in Spain and Portugal during the height of what was going on in property values in Europe, they certainly exceed that. I guess that's the bad news. The good news is they do have a new leadership team that is taking an extremely hard line on a number of different factors, corruption, as well as these credit bubbles. So you will see lots of noise coming out of China. You will see increasing defaults coming out of China as they continue to try to rein in some of these credit excesses. Where does that land them? It lands them at a slower rate of growth, still probably twice that of the United States. The challenge for the world as we continue to recover from this financial crisis is it's a question mark right now, and our conclusion from a global perspective is we are not counting on those developing economies to add significantly to growth in 2014. We are counting on the United States and other countries in the developed world to help move the global economy to the next level and higher rates of growth. Most importantly, this is not a recession scenario. It just is the continued workout from the financial crisis that began in 2007 and the deep recession that occurred in the United States and the pullbacks from other economies. If you look in history books, the workout from these sorts of situations are measured in years, not in quarters. So we have some time to go. I will take sloppy and sluggish any day of the week over a recession. That's a little bit about the economy. 2013 for the markets, I mentioned this, 30% return. 30% return for U.S. equities over as a result of 1.6% growth in the U.S. economy. It seems hard to imagine that we had a sloppy and sluggish environment, but we had this incredible view of markets. 2014 has started out quite different than 2013. It has been much more volatile. We've had already 2 corrections. It feels, or pullbacks in the market, it feels a bit more like a roller coaster. Our view is that we continue to be in what we consider a bull market. Now this is the 6th year of a bull market, and how a bull market stacked up previously in the post-World War II environment, which is relevant. There have been other bull markets that have lasted 5 years or more. This is the second best. We're already up 180% in the US since the March lows of 2009. The best over 5-year bull market in the post-World War II environment in the US was that period that started in 1982. Actually, it's when I started on Wall Street, so credit me with that. And ended in 1987. Not necessarily a great ending for a market that is not what we expect today for the U.S. markets. What we believe is fueling the markets and will continue to fuel the markets in 2014 are a number of different factors. Most important to me, no recession on the horizon for any fundamental reason. I have to go back to Ukraine. I don't think that we're going to have a geopolitical issue, but we do not see a recession in the U.S. at all. Earnings growth, think of strong corporate America. I might be frustrated with them because they're not hiring people and they're not doing an enormous amount from a capital expenditure perspective, but they have rock solid balance sheets with cash that continues to accumulate. In a growing environment, even if it's a little sloppy and sluggish, we should continue to be able to grow earnings in the U.S. They are stable to improving, and maybe that's a figure of 6 to 7 to perhaps as high as 9% growth in earnings overall. We have accommodative monetary policy. We can discuss this if we have time for questions, but I'd like to use the tagline, was it a change in policy on the part of the Federal Reserve or a rookie mistake when Janet Yellen started talking about a change in Fed policy or what was perceived to be a change in timing of Fed policy? We do not believe that there is any change in policy, so this period of low interest rates should be there for some time to come, and that too is supportive of the market. The one I always get pushback on, inflation remains low. I know food and energy costs are not low and they continue to rise, but from a core perspective from inflation, and that is the measure that the Federal Reserve looks at, we are not seeing much in the way of inflation pressures in the U.S. Economy overall. And when we talk about companies and we talk about their earnings, we have to, as investors, talk about how much we're willing to pay for every dollar in earnings. So after a spectacular 2013, whereas investors, life seemed to be coming back to normal, the issue of time and the passing of the crisis, the fact that very little happened from a negative perspective in 2013 allowed investors chose to act in a more normal fashion, paying higher rates in terms of PE multiples for the dollars in earnings that are delivered to us by corporate America. What we think for 2014 is it's hard to imagine in an environment where the economy is getting better and rates will likely move up, that we should pay any more for every dollar in earnings. And quite frankly, what we should look to is the rate of gains of earnings to be the driving force for market returns. So sort of in conclusion, where does that leave us? We think that it will be a good year for the market. It's not going to be a great year like 2013, somewhere between 7 and 10% returns. Boy, from a historical perspective, that is still a very high and very nice return. Expect as investors volatility to come back into the market. We've already experienced that so far in 2014, and it will continue, in our opinion, for the year. And as many are looking at and talk about in the media, is almost overwhelming in this. We're going to get a correction, we're going to get a correction. No one can time corrections, but after 180% move since March of 2009, corrective actions in markets are the normal course of business in markets over a long period of time. So use those as opportunities rather to look for attractive companies overall. I'm going to conclude with just one comment because I needed to go back, and my apologies. I did want to put the Ukraine in some perspective in Russia. So with this scenario that seems okay, we're doing a little bit better than we feel. It's healing on the part of the U.S. economy. It's the potential for 3% growth, and the global growth is being driven by the United States in 2014. What could disrupt that? Could the Ukraine and Russia and that situation disrupt the world economies and put us in something that is much worse than that? Our analysis says two things. I cannot predict what will happen on a geopolitical basis. We can all say, will Russia, how far will Russia particularly go with this? It's impossible to say. But I can try to assess the global economic impact of what's going on, and let's put that in very quick perspective for you. When we look at Russia today, it's less than 3% of the global economy. Less than 3%. The Ukraine is less than 1/2 of 1% of the global economy today. First and foremost, that feels fairly manageable to me. It doesn't seem like a very big number. So we need to look at a couple of other things. What about Russia's influence in the oil and natural gas markets? Russia is 11% of oil in the world today. They are 19% of natural gas. Could they do something on both those factors? I guess the answer to that is yes, but it is 50% of the revenues in Russia come from their energy resources. Would they do something so damaging that would plunge their economy into a weaker state? That's hard to imagine, but we have to agree that it might be possible. So what about exports and the exposure to the US? Our exports are less than 1% in the US of our GDP. That seems manageable to me, and quite frankly, from an import perspective of oil, it's really insignificant for the US. So who is impacted? The folks that are most impacted today by what's going on is, quite frankly, the Eurozone. And in particular, Germany is the country that is most impacted. When you look at oil imports, 50% of Germany's oil imports come from Russia, 30% of their natural gas imports. That's a big deal for them. In addition, they export quite a bit to Russia. So when you look at the Eurozone in general and the impact from their GDP perspective, it's probably 5% for Germany. It's higher than that. Germany is one of the most solid economies within the Eurozone today, which is struggling to move forward with their growth. So the bottom line for the US, we do not see a significant impact. For the Eurozone, it is still a tentative, it is still tentative growth for them because of the headwinds they have. The Ukraine and the Russian situation could impact them quite a bit if nothing is resolved. So I think I'll stop there. I will like to thank you again for the opportunity, and I don't know if we're going to take questions. Do we have time? Or... Perfect. Thank you.
Any questions? Yes.
Anything worth noting about the other BRIC economies, India in particular?
Sure. So the question, I'll repeat the question. Anything worth noting on the other BRIC, Brazil, Russia, India, and China? And the comment was specific on India. The Indian markets have been on an absolute tear, even considering all of the challenges that they've had from an economic and, quite frankly, social and political nature in India. We don't follow the markets specifically. I would say this: when we look at that whole concept of the BRIC nations in general, and we look at the investment returns, India looks to be about the best, but it is extremely volatile market. And I'm not sure if I were looking at portfolios, it would be a very, if anything, a very small portion of a portfolio.
Other questions? Yes.
You alluded to Russia's economy, and I believe that their economy, about 85% of their economy is made up of their oil and gas industry. And you touched on the fact that countries like Germany and a lot of the other European bloc countries rely on Russia for those supplies. Obviously, China, there are a variety of countries across Europe and Asia that rely on them. But how much of, in terms of an adjustment of where those countries that Russia does supply with oil and gas, could they perhaps put economic sanctions and look for alternatives to get options elsewhere to have more influence with Russia's leadership to perhaps adjust their thinking and what they're doing right now?
Yeah, that's an excellent question. So the question is, are there alternative places for them to go for some of their energy needs, this being the Euro bloc in general, and therefore can that then apply? Can they consider applying sanctions against Russia and doing that? I think that the challenge really becomes, while there is the availability of resources around the world, essentially switching suppliers is not the easiest thing in the world. So there are many places that they can source from, but the switchover is not a switchover that happens overnight. I find in this I shake my head and I'm wondering what is really going on there, not from the Russian perspective, but what is going on there from the European perspective, because Germany, who would essentially have the most to lose from a disruption in their energy resources and a disruption in their economy overall, seems to be taking an extremely passive view of all of this. Now, I don't know why. But it is it's an interesting dynamic. So really, what it appears is, even though we have delegates and Perry will be there tomorrow to have some discussions and there is some encouragement around this, it really seems that the only people who are doing anything is Russia at the moment, right? They are being more aggressive, and no one else seems to be even talking, in a very harsh tone with them. So I think, I'm not sure that I answered your question. I'm a little confused as why Germany has not taken, at least even in verbal discussions, a harder line. But the whole issue of the delivery of the resources of energy, it is possible to shift, but it doesn't happen overnight.
With the Chinese government economy contracting some, what impact do you see on your ability to continue to buy our bonds and finance our long-term debt?
So that, I knew I had to get that question, thank you. So the question is, with the Chinese economy contracting, how does that work into their ability for them to buy our bonds as we look at all of our debt situations in the U.S.? It shouldn't compromise at all, and I don't want to just say that in sort of a matter-of-fact, oh my gosh, don't worry about it. But here is the reality today, whether we like it or not, whether we agree with the debt levels we have in the U.S. or not. Even in a contracting state, so moving from somewhere from 8 to 9% growth to what might be 7 to 7.5% growth in China, they still have this need. They still have this need for foreign reserves. The U.S. continues to be the largest, the most liquid fixed income market, treasury market in the world. So if you are a player of size, and China is a player of size, you virtually, and especially in a world that still hasn't healed completely, you have very few places to go. So we would not expect to see any significant reduction unless China completely imploded and we saw something like 5% growth. We would not expect them to materially change their holdings of U.S. Treasuries.
Back.
Following up on China, I'm sure it affects growth some, but the real estate problem they know the overbuilding in so many of these cities and ghost towns that they're creating. How is that going to be worked out? Is that going to take time to resolve itself?
So the question was about the Chinese real estate problems, which we alluded to, and the gentleman, talked about what we've probably all seen on 60 Minutes, the ghost town. How will that take to resolve? It will be years, right? It will be years. And what I find interesting, encouraging, and a little disconcerting in the very short term is the attitude of this new leadership team, right? I think we'll all believe that they were doing the right thing in terms of trying to attack significant corruption that exists in China, understanding that there has been significant overbuilding, why put people to work, and as a result, these credit bubbles have existed, the investment bubbles and the real estate bubble. So how do you end all of this? I guess one thing they always talked about in the United States, even in the midst of our housing bubble, was, wouldn't it just be better to just plow them all down, right? Get rid of the inventory, right? If you no longer have an inventory problem, there's nothing to weigh on. But the reality is you can't really do that in China. I'm not sure if we can define how long it will take, but it will take a number of years to unwind some of the excesses that have been there. So what's the bottom line? The bottom line is, I think, a couple of things. Expect a slower growth rate for China. The fear today was that they would grow at 6%, year over year was 7.4%. You expect a slower growth rate, expect this transition and this transformation in their economy as they try to push it to be more consumption driven. But the more interesting part of this is expect the difference in growth rates between the developed world, so think Euro, the United States, Europe, and you can think Japan, and those developing economies. Those growth rates are compressing. The world is starting to look more similar to each other in terms of overall growth rates. But the short answer, which I should have gotten to in the beginning, is it's going to take a long time.
Question? In the back? Questions? Yes.
In terms of continuing deficits by governments, what do you expect inflation to be, let's say, 5 years out?
So if I heard the question correctly, if we continue to look at the deficit situation, and deficit situation. And what would be our expectations for inflation 5 years out? Well, 5 years seems like a long time to me, and it's quite frankly a bit outside of the typical forecast horizon that we do. But I would say there are a couple of things. 5 years from now, I would, if we don't have higher levels of inflation, then we have actually a bigger problem than you can possibly imagine. You know, the concern many of us have is that while we look at these higher prices in terms of food and energy, the real concern we have is that the forces in the U.S. economy, and quite frankly in Europe in particular, are more deflationary, where prices are actually moving down rather than up. The Japan situation, that once you get into a deflationary spiral, it is nearly impossible to reverse that trend and go up. So here would be our thought is a couple of different things, and it does play into the debt situation. So it's a matter of making choices in the short term. So the choice right now is, how do you get the U.S. economy back on track to something that is sustainable, right? We're not yet in a sustainable economic recovery in the U.S. by almost any historic measure. So the first thing is, do whatever you have to do, and that's what they've been doing. Do whatever you have to do to make sure it's not deflation, to make sure you drive the economy to something different. And something different, we believe, in 2014 begins the process of a more normalization, a more normal environment for rates. So what you do at the same time is you ignore the debt situation in an ultra-low interest rate environment. It has not been an impact. Once you get to more normal rates, you should start to see the Federal Reserve normalize their interest rate policy. We think that comes in probably at the end of 2015. Lots of money sloshing around. Well, there's lots of money being printed, but it's not really sloshing around too much in terms of the economy. You start to normalize. Inflation levels should come up to more normal. We're not in the view that it's hyperinflation. You know, those are rates of 5 and 7%. We don't see that happening. But I would say over the next 5 years, we should probably be in an inflation environment of 3 to 4%, maybe even higher. Long answer, sorry.
Any brief comments on the effect of the Affordable Care Act on the U.S. economy?
Sure, I'll give that a shot. The question was, any brief comments on the impact of the Affordable Care Act on the U.S. economy? So there have been a number of different pieces that have been written about this, and I think we should start with really the Congressional Budget Office that put out a release probably 2 months ago, and their view, now keep in mind the Congressional Budget Office is required to make their assessments based on current law, right? So they can't go outside of that, and they make their assessments on current law, and they have had a nice history of forecasting with some degree, with a significant degree of accuracy. So the Congressional Budget Office basically came out 2 months ago and said a couple of things. It will, their view was the Affordable Care Act would add overall to deficits in the U.S., and it would hurt employment over a period of time. Now, they said when you looked at the number of people that they thought would be impacted by the enactment of by the Affordable Care Act, I believe that the number is they were talking about another 2 million people that would be unemployed as a result. That seems like a large number. They said that number would take place between now and probably 2022, if my memory serves me correctly. So certainly an impact to the overall economy, and part of that is if there's an impact in terms of employment, there's the potential impact to slow the economy. I'd also like to look at it from a different perspective, because the other perspective I often hear, so near term, not really seeing a huge number that I can say, let's shave 3.0% to 2.9% as a result of the Affordable Care Act. I think where everyone is trying to get their heads around, and RBC is also, is looking at this situation of small businesses in the U.S., right? So it's that 50 employee level, over 50, you know, you have to offer a plan under 50. So how many small businesses, which account for roughly 40% of employment in the U.S., are playing around that 50 line? Boy, I'm close to 50, I'm never going to get there. That's adding to this hesitancy to hire people in what is a growing economy. And I'm over 50, what the heck, let me get rid of a couple people so I can back down to that, right? That's a real concern. Some of the numbers I've looked at is that when we look at the small business community in the U.S., 2/3 of the small businesses in the U.S. are firms that have been typically operating with employees in the range of 20 to 40, right? So I don't think the 40-person employee is necessarily getting up to 50. That's a pretty big expansion. And if you're under 50, this is not an issue. So that's the one I'm trying to get my hands around. I think there is an impact, a potential weighing on the economy, a potential weighing on employment, and I do believe that there are some decisions around that 50 line which might be contributing to the hesitancy on the part of small businesses in particular to hire people right now.
Question? Oh, last one.
With the population getting older, what is the impact on market returns?
Well, just on the economy and how that could impact our.
Sure. So the question really was about demographics. So what you can translate GDP into population growth times productivity, all sorts of things. So if we have an aging baby boomer population, and we do, what is the impact for the U.S. economy? We actually wrote a piece on this, oh gosh, eons ago. We've written a lot of pieces, and I get older every year. So we called it the demographic shock, what investors need to know. And the notion was that as you age, as your population ages, your potential growth in GDP as a result has to decline. There are other studies, by the way, I'm looking at the debt. So if you get to debt levels of over 80%, by definition, all developed economies are immediately penalized by higher levels of debt, and they slow down overall. So that view would lead us to believe that if you were in the camp that suggested that the long-term trajectory for the U.S. economy is 4%, it's not going to happen. 3.5%. I think we'll all probably agree at some point that because of demographic factors and debt levels, the long-term trajectory in the U.S. economy, or the longer-term average, will likely come under 3%, maybe 2.8%. That's the bad news. The good news is when you actually look at, we have a gap, and so it's going to take some time, but when you start looking layers below the baby boomers, you actually have started to see a resurgence in population, and we can all talk about trends related to millennials, and there are investing trends related to millennials, and we look at household formations in general. There is some positive demographic conclusions that are happening in the United States, including birth rates overall. And birth rates overall in the U.S. are, quite frankly, among the best in the developed world today. So they're not huge, but they're among the best in the developed world. So we are going to have this gap, and it is going to impact growth, one level of growth, probably for the next, let's call it 10 years or so, maybe even more than that, in terms of our upside potential, but it should not be a dramatic detractor. The real issue is quite frankly dealing with the entitlement programs around this very important demographic that is also the situation tied in with our debt problems overall.
Thanks for your insight, Janet. She'll be available for questions afterwards if you have any. Just want to remind you that next week our meeting will be held off-site at Santander Stadium for the meet and greet program with the players and presentations by President and General Manager Rotary Eric Menzer and Field Manager Mark Mason. Please pre-register your guests for this event with birth by Friday, the 18th. In the early 1900s, Albert Einstein said the hardest thing to understand in the world is the income tax.